guys, what have we learned on our journey to financial independence and our high dividend yields? Stick with us and we'll let you know.
Hey guys, welcome back. My name is Jean.
And I'm Christine.
We are so happy to have you with us today. If you are new to this channel, we are a Canadian couple in our mid to late 40s living in Toronto, Canada. And this is the channel where we share with you our journey to financial independence. If you are new here, please consider subscribing using the buttons what?
Wherever they are.
Wherever they are. Yeah. We would love to have you on our journey to financial independence. On today's topic, as Christine has mentioned before, we will be discussing with you some of the lessons that we have learned with regards of the dividend yield. Have you heard of the dividend yield? Do you know what the yield is when evaluating stock? So this is our topic today. Before getting into this topic, we consider ourselves hybrid investors, which is basically a combination of dividend stocks, ETFs, and real estate. However, as Christine has mentioned today, we wanted to discuss some of the lessons that we have learned along our way to financial independence, and especially the dividend yield. But first of all, what the heck is an yield?
What is the dividend yield?
Yes.
There's many different kinds of yields when you're talking about stocks.
See, she is freaking smart.
But the dividend yield, it's basically how much you're going to get paid based on the stocks that you're buying. So dividend yield equals the annual dividend per share divided by the current share price. So it actually can fluctuate quite a bit, yes, depending on the cost and the price of the shares at any given point.
So which is something that it's really important that we actually learned last year, because when I was looking at those beautiful yields of 10, 11, 12%, I told Christine, let's go, let's get it, and guess what? It is only because during COVID, that's when we dumped a lot of money in the market. So the prices of the stocks were down, meaning that the yield was actually going up.
Mm-hmm. Yeah, exactly. So the dividend yield is quite an attractive feature to look at when you're trying to evaluate which stocks to buy, because it's basically how much you're going to be getting paid as a shareholder to hold any given stocks. Yeah. So the tendency to try and seek the higher yields it's attractive, right?
Yeah.
Everybody
but
wants
dangerous.
to get paid more.
Yes.
But there's certain things that you definitely need to take into consideration when you're looking at these stocks that have some pretty high yields. Yeah. For us, our new target yield that we try to stick between is usually between 3 to 5%, sometimes 6%, if the company is a pretty sound and stable company.
Yes.
So there's pros and cons to having a high yield as a dividend yield in any given stock. So some of the pros are you get paid more money, right? And so when you're looking to live off of dividends in retirement, this is an attractive feature. You're going to be making more on a quarterly or monthly basis depending on how your stock pays out.
And it's quite difficult, well, I would not say, but sometimes people are really focused on the yield, which it might be good for them, so we totally get it. But on our case, what we are looking now, dividend is important, yes. However, we still have a long way to go once we are investing, right? So meaning that with a higher yield, it means a lower growth. So we might not see a lot of growth along the way.
Yeah, so that's one of the cons, is that because you have a higher yield, there's less potential there. Your stock is basically already grown and it's a stable company, you've got a decent yield, and there's less chance that your stock is going to grow and you're going to see that capital appreciation as well as getting paid dividends. So one other con is that if your yield is too high on a stock, then you're susceptible to a dividend cut. Because the dividends are paid out of the free cash flow or the money that the company has available to them to pay its shareholders, if it's too high, if they're paying out too much money to you as a shareholder and they can't sustain that dividend, or they need the money to pay off debts or something else, then you stand a chance of having your dividend cut, which people have actually seen quite a bit this past year with COVID and the financial hardships that a lot of companies have seen.
It even happened with us. I mean, we own RioCan, which is a REIT, and we did have a cut last year of,
40 some odd percent.
40 or maybe 50. I don't even know how
A
much,
lot.
but it's basically half. So if you are, invested only on RioCan and you are expecting, let's say, $10,000 per year, if your yield is cut by half, so instead of getting 10,000, it's gonna be maybe 5,000. So is this something that you're looking for or not? So we always have to consider that.
Yeah,
right?
especially when we're looking to live off of dividends, we want to make sure that the companies that we're going to be invested in are stable and consistent and will continue to pay their dividends, as well as grow those dividends.
Yeah,
So,
that's also important.
yeah, so we're going to get into the things that we look at when evaluating a stock.
Before I forget, I love this part. There we go. There it is right here. We're gonna have a link to our playlist where we share every single month the dividend income that we do receive from our stocks, right? So if you haven't seen it before, I will recommend you to go and take a look and see how we are progressing towards our journey to financial independence.
Yeah. So, like always, we recommend everybody do their own research before investing in anything. But we just wanted to go over a few of the areas that we now take a look at and try and evaluate our stock choices on, just to kind of give us a better idea of how a stock or a company is performing and if it would continue to perform for us now and into the future.
Yeah. Remember, we are not financial advisors. Do your own researches. It's really, really, really important. Don't hear only to us. Take a look on other, channels on YouTube, blogs. Talk to people, read information on a newspaper, on Facebook, but do your own research. This is really important, and you should do it. Don't trust us, right?
Well, they can trust us, but we're not giving them advice.
No, and it drives me crazy when I go to YouTube and people say, buy this, buy that. No, don't buy, do your research. It is really important. It drives me crazy. I'm sorry, but I have to say that. Now I feel good.
Perfect. So one of the first things that we start to look at when we're trying to decide whether or not to invest in any given stock, not only do we look at the dividend yield. If it's in the negative, we're not even going to look at the stock. It has to have some sort of a dividend payout for us, because at the end of the day, that's what we're looking for. But one of the things that we take into account is the payout ratio. Many people may ask, what is the payout ratio? That's actually the percentage of earnings that the company makes that's paid out in dividends to a shareholder. So, I mean, it's only one of many things, right?
Yeah.
But it's important to know how much money your company is paying, right? And if they have, and how much of that money is staying within the company. Because like everybody, any household, every company has operating expenses, right? So if they're giving all of their money to their shareholders, well, unless it's a REIT, you're not leaving much there for any type of growth within the company as well. So the payout ratio is a pretty important one.
Yeah. So if you think of like 100%, right? So you put your money on the company and you are expecting the money to, the company to pay you back. Once you are looking at the payout ratio, consider maybe something around 75%, which is usually what we consider.
Look for. Yeah. Anything higher than 75% can be slightly concerning, at least for us, just if the company's not leaving a lot of money in their cash reserves or in cash in order to pay out other things that need to be paid for the company, right? So if their payout ratio is too high, it could mean that the dividend itself is not stable.
Not stable at all. Yeah. So if the payout ratio it might be the opposite, it might be too low. So it might, something that it might be interest to you, because on cases like this, we might see an opportunity for the dividend to grow, right?
Not only the dividend, if the payout ratio is lower, there's more capital left in the company, and therefore that company may actually still be in the process of growing. So you might see double growth, right? Not only is your stock price appreciating and growing, but so is your dividend.
Yes.
So it's a double.
That's enough talk. Why don't we show on the screen right now where to find this information? It might be on other websites, even on the company website. You can take a look on Yahoo Finance, you can take a look on Seeking Alpha. There are actually websites kind of specialized on that, and we do use one of them. So we are gonna share on the screen with you Pepsi. So you know Pepsi, our friends in the United States. Pepsi is a company that we have there. As you can see on the screen, let's take a look at the bottom now. You can see that Pepsi, as of today, its payout ratio is around 75.5%. So it's one item that you do consider. There are more.
And it's okay. I think that Pepsi has a bit of on the higher end of the payout ratio, only because it's such an established company. It's not going anywhere. We know that people are going to continue to drink Pepsi, same as Coke, right? It's a staple in most households, even around the world. So it's a pretty good, even though it's a little bit higher, that's okay because I think it's still a pretty stable dividend.
Yeah, and as Christine has mentioned before, payout ratio, dividend yield, they are not the only ones. There are more and more and more things that you have to consider once we are analyzing a stock.
Right? The next one is the CAGR. So it's the compound annual growth rate. And basically what you're looking for when you're trying to evaluate the CAGR is obviously just that. You want to see something that's growing over time. It's not staying flat or stagnant, and it's not definitely declining. Anything that's declining, it should be a red flag to anybody. But you want to see that nice steady growth over 3, 5, 10-year period.
Yeah, exactly. Let's look now to one company here in Canada that we wanted to share with you, which is, here you go, my Portuguese, English, French accent, Alimentation Couche-Tard.
Very good.
Good. Okay, let's look at the graphic.
Maybe our French Canadian friends can help us out.
Let me know if I suck. Yeah. So let's look at the Couche-Tard. If you can see on the coupon, like the CAGR that Christine was mentioning before, in 3 years you can see 24.8, 5-year growth 21, and 10-year growth 26. So you basically see that the company is actually growing.
Right.
And if we can come back to the payout ratio that Christine was mentioning before, look, the payout ratio is only 90%. So
No,
it's
9.
Yeah. Did I say 90?
Yeah.
No, 90, not 90, 9%. Meaning that the company has a lot of opportunity to grow, right? So this is another...
Lots of cash left over
Yeah.
to make further purchases or to acquire new. Alimentation Couche-Tard is actually a convenience store chain.
Yeah.
So they look at acquiring more and more convenience stores, and they're quite large across North America and even into Europe.
And Europe, yeah. More. I guess it's more Europe than here, actually. Yeah.
So, okay, so the third one that we're going to look at today in this video, I mean, there's many things to look at to evaluate whether a stock is good or not, but in this video, for our purposes today, the third one that we tend to look at a lot is free cash flow. So how much money does the company have in cash that they can pay dividends to us as shareholders, accumulate new assets, pay off debts, stuff like that.
And keep investing, right?
Yeah, and keep investing back into themselves. So free cash flow.
If you take a look on Pepsi since 2016 until 2020, you can see that the cash flow is kind of growing. Even though you can see that the CAGR is minus 3.5, it might be something that you have to evaluate and see if it's worth it or not. But that's usually the line that we tend to. It's not free cash flow. You also have operating cash flow. I mean, as we said before, there are so many things to consider. We just want to give you something that you can take a look. That's Pepsi, the first example. But let's now take a look at another one, which is GE. You are very familiar with GE, which is General Electric. If you take a look on GE's cash flow, it's quite bad. It's negative, and this is actually something that I would not invest on GE right now. It's a big company. We understand that it might be difficult for them to adapt to the new reality and the things that they are facing now. But as long as I see free cash flow negative, this is, like a red flag for us. And on this case, we would not invest on GE.
That's right. So those are just 3 of the areas that we look at when evaluating a stock. Now, that being said, there are certain stocks out there that have very high dividend yields that are very attractive to people and do serve a very good purpose, depending on the stage you're at in your financial journey. So one of the high yield dividend stocks or ETFs that we initially had purchased and bought into was QYLD, and it had a dividend or a distribution payout of 11 or 12%.
Yeah.
Very attractive. It was very consistent. I don't
That's
think there
how
was...
we bought it. I was the one who...
Well, I mean, it serves its purpose, right? There is definitely a purpose for that particular fund. And it very well could make a reappearance in our portfolio, but several years from now. So we've been asked frequently why we sold out of QYLD. We sold out of QYLD because we bought into the Qs themselves. Right now, we are looking for growth in our investments. Not so much, yes, we want the consistent dividend payout. However, we want to grow our base investments so that we can then have a larger dividend payout every month, right?
Exactly.
Once we sell out of something and maybe buy back into a QYLD.
Yeah. Do you want to see why? Let's take a look at this graphic that you see on the screen, right? So as you can see on this graphic, what we have QYLD and also the Qs. The QYLD is the purple line and the Qs is the green one. When we do consider over the last, I guess it's over the last 5 years, QYLD has grown 67.7%. However, QQQ, they have grown 216.2%. So it's a lot of difference, and then we thought, you know what, we have to change our approach. And since we're looking for growth, right now it's important for us to sell our position on QYLD and buy into the Qs, and that's what we did it.
Yeah, so, and we've done this within the RRSPs because these are both obviously American funds.
Yeah.
And so we can sneak away from the withholding taxes inside our RRSP. And not to mention, we just want to grow that money as much as possible so that when we need to begin taking it out, we can start taking it out and potentially put it into a QYLD inside of our margin account or something like that, where we're going to have access to those monthly distributions as a type of cash flow for us, as opposed to inside our RRSP. Yeah, it's great, but we don't have access to it.
Exactly.
Yeah, so that's why we sold out of QYLD. I don't know how many of you actually hold it within your portfolios or what you might think of that type of a fund. Let us know in the comments down below. Do you think we did the right thing? I don't know. I think we did.
Yes, I think that we did. And what about you? Are these some of the considerations that we have when you're evaluating a stock? Use the comments below and let's share, let's learn from each other. As we have mentioned before, those are not the only ones. There are more things that we have to consider. Remember, we are not financial experts. This is what we have learned along the way. We have made, I should say, I have made the mistake in investing in high dividend yields, and it was not sustainable at all, right? So do your own research, see what it fits your criteria, and how many years are you away or not from, from your financial independence, and keep that in mind.
Yeah, so we're only 3 years away because 2024 is coming up real fast. So we might look at investing back into QYLD in 2024.
We might. I don't know if it's 2024. It might be 2028. We are still debating. Good one. But the most important part is having you, in our journey to financial independence.
Yeah. So thanks for joining us. We hope to see you. Sorry for the delay this week. Life kind of got in the way. So we were a little late in releasing a video, real late. So it's like a week, 2 weeks later. But anyways, we'll see you next week.
Thank you very much, and thanks for letting us be part of your journey. Take care. Stay safe.
Bye.
Bye. Oh, I have to do it.
You're going to need a new color cartridge. You should be printing those in black and white.
I know, but I have another one. The other one that I have, is it black and white?
Probably. I don't know. I'll have to double check it. Good job, Amor.
Good job.
Now you got to edit a lot of things. Oh shoot, we're still recording. Oops.
Yeah, and another what? Is it another pro or another con?
I have no idea what you're going to say.
I don't know. We got lost on this area, didn't we?
Yeah, you jumped down here.
Yeah, what I was supposed to say. Should we talk about...
But it's the same thing.
Yeah.
Right?
Yeah.
Okay, ready?
Yeah.
Can you edit all that in?
Yes, we should have enough time, right?
I think so, yeah. We got one more con and then we'll stop it.
Yeah. Invest in to receive, you know, like the $40,000. What?
I think we're out of time. Yeah.
Yeah. Is it really working? Do you think so?
What do you mean?
Like the video and all of this stuff?
I think so.
Yeah?
Yeah.
Okay. So now it's